And welcome back for another weekly market recap. The month of November ended. It's now the first day of December, and we are closer and closer to the holidays. Now, I might have to post a video at a point because I am expecting a delivery, but unfortunately, I'm home alone, so I'm gonna have to check the door just in case. Now, saying holidays, December, Home Alone, my mind immediately traveled back to the movie Home Alone. Gee, hell of a movie for the holidays. That plus Trading Places with Eddie Murphy, right? I guess these year too. I'm gonna have to watch them both. Every single year which goes by, I always I'm always on my feet for that infamous orange sales report. Right? But without going out of a tangent, let's start out and see what happened. It was a shortened week in the US because of Thanksgiving, of course. So, main US markets didn't really move like a lot. We're gonna look at it now, but let's start out with the economic calendar first. And as you can see, everything was particularly focused in the first half of the week, of course. We didn't have a lot in terms of high impact news, of course. Now we got, if we do only look at the US, we got the consumer board, consumer confidence, which came in quite good. I mean, above the previews and kind of in line with expectations. Then we got FMC meetings, but quite honestly, I didn't really follow it. I normally just follow the press conferences when Powell is talking, usually for interest rate decisions and whatnot. The preliminary GDP was kind of in line with expectations and still hovering around that high twos, almost 3%, about the 3%. If you don't know if you heard, but we got a new Treasury Secretary, Besant, and I think he was given the mandate of, operating upon the 3-3-3 rule, right? So if I remember correctly, it was about pushing GDP to 3% and reducing government deficit by 3% by 2027, 2029, right, something like that, and pulling out 3 million more barrels of oil per day. I mean, it could be slightly wrong, but I was stuck on these 333, right? But just for the sake of it. Unemployment claims, they came in line, nothing major. Even if you look at the trend, right? They're not loading. No, okay. They are still on these downside trajectories. So after the spike, so it turns out, might be true what they said about, the hurricanes, Milton and Helene, which caused this spike in the claims, and now they are just rolling back down. Could be. I mean, it would be a nice signal for the labor market, although I don't think that's all there is, but still, on paper, should be good. Uh, what else? Oh, of course, PCE came in kind of in line with expectations and still hovering around that 30 basis points. It's kind of like when you look about CPI forecasts, they're always around 20 basis points, right? Because I guess that's the normal, the average that they would like to have. Because if you multiply that for 12 months, you got kind of 2% at the end of it, which is the target for inflation that they usually got. So it's all good. What wasn't good was Europe, of course. If you look at Germany, preliminary CPI, month over month came in negative actually. So it is a preliminary, so how much weight would you put on it? Still would indicate that Germany is in disinflation. Not to mention Germany, it is in a recession, like probably all the euro area, right? Um, they just didn't tell us yet. But and what else? Well, of course, after Thursday, Friday, we got basically almost no trading. Thursday in the US, markets were closed. They traded like half a day on Friday, so nothing really fancy the rest of the week. Um, So again, there is really nothing major. There are other things which came out, but not strictly from the economic calendar or the price action, especially in indices. But let's start out with charts. Let's look at gold. Now, I decided since the end of the month, and we just started out a new month, to look at the monthly chart of pretty much the first tabs that I got on TradingView. And if you look at gold, right, I mean, sometimes zooming out, it gives you a different perspective, right? And it works with gold. We'll see it's going to work for other assets. But I mean, it's been 2 weeks, more or less, and everyone's talking about gold peaked out, gold topped out, right? This is the top. That's it for 2024. Gold now need to trade back down to retrace back down to 2,200, something like it. And I was like, well, okay, it's a hell of a call, but it's based on what? I mean, yeah, I could. I'm not saying couldn't, but it's based on what? Um, because if it is a fundamental thing, then all right. But from a price action standpoint, I don't yet see it. So again, it looks like at the end of it, this month was just a little bit of a consolidation, right? The month of November market open at the around the highs, came back down, and then it was, the entire candle was absorbed and it found bids and traded back to the upside. And when you zoom in, you can clearly see, right, 2 weeks down, one massive week of a bounce, and now it's just trading in this range. So if you remember, I was talking 2 weeks ago about a little bit of a consolidation in gold, and then came coming back to it the following week. I said, oh, I wasn't expecting this bounce. I was expecting a little bit of a consolidation. Well, it turns out that at the end of it, you give it a little bit more of a time, and it is actually consolidating, because the way we opened up on Monday was a drastic down candle, and then we stayed inside that weekly opening candle for the rest of the week. Again, it could just be because it was a light volumes trading week, totally be, but I think, at the end of it, as for now, since we look at it every single week, so week by week, but as for now, I don't really see a hell of a lot of selling pressure on gold. If anything, it is just consolidating. And I warned you, it could consolidate like it did into here, and I could keep on going higher. We don't know. That's why we always wait for confirmation. Now, that doesn't mean, as I said, that you shouldn't or couldn't they risk. Let's say you got positions on. It's more than fair if you know, take some profits, uh, take a little bit of the positions off, and you actually lock in those profits. It's no brainer, right? Nobody ever went broke by taking profits. It might be that 6 months, 1 year from now, you kind of, I sold a bit and then it just went up massively. Maybe I shouldn't have sold. Yeah, right. What if it collapses instead? You immediately transition from maybe should have hold to should have sold. Right. So again, you never know. And since you don't know, the only thing you could do is manage your risk, uh, which in this case would be managing your exposure. Right. Let's check oil on the monthly chart. And again, it's just in this massive trading range. It's been in here since December 2021. So now it's almost 3 years, which is what you expect from oil. I mean, at the end of it, it's a commodity. Uh, Probably, and I don't want to, shit on the other commodities, but probably the most important commodities out there. Oil would be surely at the first place in my book. There are many others which are important, of course, but all in all, it looks like the world kind of trembles when oil is doing some weird shit. So this is why I keep a particular attention uh, on oil. I pay very close attention to it, as you can see. Now, these 2 months basically just consolidation. If you want to zoom in a little bit, You see again, it's just a trading range, and it's much more evident on a daily time frame, as we spoke about it basically since forever now. At least it looks like forever, right? It feels like forever. Had that massive spike. Well, again, you see how it works, right? It stays in a range for what, like 2 months, and every time you see a move like these, immediately you kind of like, oh, that was a big move, right? Well, really? Well, not really. I mean, these was a big move, right? These was a big move. These was a big move. And to the upside, these might have been a big move. These might have been a big move, but these, it is just consolidation. But you get used to the low volatility environment, right? And so when you see something moving a little bit, it looks like, finally it's moving, it's doing something, right? Yeah, anyway, it still feels weak to me. I keep on having this feeling when I look at this chart. It looks weak, it looks heavy. And again, as I said, it could rip to the upside in this trading range, but overall, it keeps on coming back down to the lows. So I take it as a sign of weakness again. And so we'll see what happens. Now you might say, well, but with the holiday coming in, you should see a little bit of a spike in transportations because of all the, let's say, the Black Fridays, online purchasing, right? All those sales that needs to be delivered, right? And so you might see a little bit of a spike in the demand for oil, or then you might have, people moving around. They maybe are going to visit their relatives, their families, so they need to travel more, so you need more oil for moving people around. Well, apparently not yet. So I don't know what to tell you, but it really it doesn't look like it wants to go up and up and up in the nearest futures, right? In the nearest future. Slippery tongue. Had a little bit of a rough night, to be fair. Let's check the break evens because I was particularly undecided about these. And this always brings me back to something like that type of a logic. It's you got what you do consider some sort of an indicator and actually leading indicator for oil, right? And we have been through all this period where oil was consolidating in here, but the break evens were kind of grinding higher. And if you remember my past videos, I was always, yeah, I mean, I know the signal is there, but do I really want to believe this one? And I guess it was 2 weeks ago where I said, look, I'm aware that usually this indicator is particularly good, but in this specific case, I'll stick to the price action instead. And I keep on holding my ground and saying to me, oil, it's still bearish a little bit. And yeah, finally they kind of look like they're topping out, maybe. Uh, does it mean that oil will crash back down, I don't know, below $60 per barrel tomorrow? No, not necessarily. But at the same time, it might not mean that oil will spike up into the 80s, right? It's the same premise. So again, sure as hell, I'll keep on monitoring them. And I look for massive divergences, but I mean, look at it. Um, check the date. October 15, let's say. It's where these momentum to the upside kind of faded, and we started to trade a bit more in the chop, right? And it's kind of like when October 15, mid-October, would be kind of like in here, right? It's kind of like where oil had that spike, came back down, and went into low volatility once again. So I guess, there are many ways of reading and interpreting indicators and signals. It all depends on what you're trying to look for and how, maybe the level of confidence that you have with the specific indicator. But that wasn't statistical, right? I want to be particularly transparent and honest. It wasn't something which was based on statistics, numbers, and math and whatnot. It was just gut feeling, as you said, well, as I said, right? So again, Just because this time it seems like it's working, does it mean it's gonna keep on working in the future? Or next time I wouldn't be massively wrong on it? Yeah, absolutely. I could be wrong every single time, but it's just when you pair it up with a lot of different other metrics in the macro data out there, my conclusion was, I think it's still weak, right? Now let's transition to Bitcoin. Well, again, this is another market, a little bit like gold, where everyone is now trying to call the top. Um, we got this huge consolidation, and then finally we broke out in the month of November, uh, and people called for a top. Um, like I mean, I don't know, right? It's not that I'm saying this is not, but at the same time, I'm not saying it is. It's just I don't know. To me, let's say I don't see huge evidences of a top, at least on a higher time frame. Like it could be a monthly chart. It could be, if we can load it up again. Trading view today is a bit slow. Like if you look at weekly chart, we completed this cap and handle and we broke out. So I mean, let's let's put it this way. If you wanna say this is a top in the sense that we might have a little bit of a pullback, kind of like, and then we keep on grinding higher, then maybe we got the initial pop out of the massive pattern, or a little bit of a consolidation, maybe a slightly pullback, and then up and up. You know, could be. Many people actually hurt themselves pretty badly trying to call top continuously, and that's the thing about calling tops, calling recessions, calling bottoms, is that you're gonna be right eventually. But if you're really putting money on the line, you need to be very careful, because it might be that up until a point where you are finally right, you're gonna be doing your ass pretty badly and maybe go broke and go bust before being right. So pay attention to it, right? Now, we had this little bit of a pullback, and then we rebounded, and we are now trading in this range once again. So I don't see a particular case for a major pullback yet. Absolutely not. If anything, this price action is actually suggesting a bit more of upside. Um, it's kind of like what you've seen in here, let's say. That is a perfect example, even for the timing. Look at it. Look at it. We got in here consolidation from mid-March up to basically the end of October, let's call it. We got consolidation from the end of March, kinda, and breaking out mid October. So kind of the same time span. If you check what happened next, you see the initial pop, then you see the market starting to be a bit more volatile, grinding though to the upside. So again, up until the point you see the market behaving like this, it's very hard for me to call a top. Now, of course, if you zoom in, let's say you go on an hourly chart, right? You can call all the tops and bottoms you want in these. And don't get me wrong, these movements intra-week, they are very, very tradable, and you can make a decent amount of money by doing so. But just because you think there is some sort of a top on an hourly time frame, it doesn't mean that the weekly structure is going to be fucked. Right, so just time frame relevancy and time frame hierarchy counts, and it counts like a lot. So don't ever discard that. Okay. Um, Other than that, um, there was maybe something I wanted to bring on about Bitcoin. I just forgot where I got it. Probably near. Yeah, there you go. It looks like at least standing to this chart, it looks like from a seasonality standpoint, we got back in a period where cumulative returns should be diminished. Now, again, it's another nuanced thing. Always be careful when you look at seasonality type of studies, because just, it's some sort of an average, right? Um, and the nature of an average, it means that, you know, There are periods where the metric you're looking at is above the average, and there are periods where it is below the average. So bottom line is it doesn't always play out like the seasonality would suggest. And although you might say this is it, like kind of like with gold, right? Although you might say this is it for 2024, pay attention because you might be wrong on it. And so don't go balls deep short just because seasonality says this is it. Okay. If anything, what it might suggest is a little bit of volatility coming in, but we know that volatility cuts both ways. So yeah, just be careful. On the lower part of this chart, I don't fully agree. Actually, I completely disagree. Like they're pairing up the price action of Bitcoin with the RSI, and they say, yeah, they are highlighting periods where it was overbought. Uh, Look, I'm not huge on RSI and shit. Like I don't really use it a lot, but even with a naked eye, you can see that yeah, it was overbought, and guess what? It kept on going higher. Yeah, it was overbought, and it kept on going higher again for a decent amount of time before actually pulling back a bit. And for a little bit more of a pronounced pullback, it went higher than that. So again, even here, it was massively overbought, right? But you know, it came back near the highs. What you should look on RSI is really divergences. That's it. Divergences in relative strength. So other than that, I wouldn't put too much emphasis into this chart, right? Just trade the price action. It's way better for you at the end of it. I mean, or at least if you want to use these indicators, you need to know how to use them, right? Otherwise, they're pointless. Let's move to indices. If you look on a monthly chart, right? Again, the crash is coming, the recession is coming, doom and gloom. But I mean, really, doesn't look so. I mean, if you look at the small caps and the Dow, you might say, yeah, well, it's a little bit extended to the upside, especially the Russell. It could be a little bit extended overall. So, tiny consolidations throughout the next month or the beginning of next year, maybe a little bit of a pullback here and there, like your usual 2-3% type of pullbacks. Yeah, but doom and gloom, uh, people talking about 2008 at this stage, but no, I mean, no, I don't see it. And now again, it might be, yeah, but that's the nature of crashes and financial crises. No one sees them coming, otherwise they wouldn't exist. Because if everyone would see them coming, they would edge themselves. I think they wouldn't need to deleverage so quickly and basically scrambling for the door when shit hits the fan because they are all set up. They structure their balance sheets and the portfolio in order to be able to sustain that type of a drawdown. So you wouldn't have that sharp drawback or drawdown. Yeah, I mean, understandable. But if we just look at the charts, if anything, what I'm noticing is that the tech sector, so aka the Nasdaq, it is struggling a bit compared to the others. So the S&P made new highs, didn't really close, not on a closing base, but yeah, it traded above the previous all-time highs, so I take it as a positive. Same for the others, like the Dow, the Russell. The S&P didn't yet, so I don't know. It could be like and I'm just postulating and making hypotheses. There is nothing definitive here, right? It might be that if you see an actual top starting to be confirmed in here, what you could say maybe is, okay, so these went higher, these stayed lower. So if you see a top confirmed and you are hunting for short, just short this one because the relative strength shows that this is the weaker. That's that's kind of the most bearish thing I can read into it right here, right now. So yeah, we don't have, even in this case, don't have evidences for a top. And again, with seasonality, with all we discussed, like performance chase, many money manager sub allocated, the window dressing stuff that you got getting into the end of the year, the Santa rally, there are many things pointing to the upside. But the most important for me would be the obscene amount of corporate share buybacks which are coming in. They started to come in at the mid-November, basically after we closed earning seasons, uh, and they are set up to be 6 billions per day. So a lot of buying pressure there. Of course, you could always have your black swan events, and that goes out the window. But as a general bias, I'd say up, right? If you look at the monthly chart of the ETFs, like the spiders and the Qs, we are not. I mean, a little bit less on the Qs. You might say, well, on the S&P, we start to be a bit deviated from moving averages, so a bit of a pullback. Yeah, but even if you look at it, we got pullbacks in the past, but the market overall stayed intact. The market structure stayed intact, and we kept on grinding uh, higher and higher. So just just trade the fucking trend at the end of it, right? I don't really, yeah, I don't really see anything which would suggest a massive crashing coming. Um, I mean, again, it's a matter of time frame relevancy, right? Uh, I don't see in the price action anything which suggests a potential huge retracement coming. That doesn't mean that there are not signs of potential risks into the future. So again, this is something that people struggle a lot with. Like one thing it's saying, yeah, I see these potential risks, okay, but just because you see a potential risk, it doesn't mean that it's going to manifest itself tomorrow, right? So now, of course, as I said in the beginning, I got to take the dot for that delivery, so I completely lost my train of thoughts. We were talking about deviation from averages, corporate share buybacks. What else? Well, essentially, yeah, just let's say, we are still on a upwards trajectory, and it's gonna be strange to listen back to it later on, but that's just life, right? Let's put it this way, okay? If you want to look at a few reasons why indices, but the markets in general are massively bullish right now, we could check a few data that I picked up this week, um, which clearly shows that there is a lot of confidence and to some degree exuberance on the side of investors recently markets. I mean, it's nothing like it's not rocket science. Someone might say, yeah, just look at the charts. It's undeniable, right? But sometimes it helps to look at this. Now, this is the amount of volumes getting in into leveraged ATF on single stocks. So, I mean, the hyper financialization, the proliferation of new tools and instruments to allow you to pour money, to throw money at these financial markets is going off the charts. And, to some degree, we might say, yeah, that's good. I mean, that's one of the main reasons why the market is so up, right? Yeah, on the other side, it shows you massive exuberance, and we do know how exuberance tends to, end up at a point. So to some degree is a motivation, but to the other is one of those potential risks for the future, right? Um, I mean, if you look at the allocation or equity exposure, I mean, this is an average of retail investors and professionals, but you can still see it's quite high levels, and you don't see these levels, if not in 2017, right? And if you overlay the price of the S&P, you can see that basically when we reached into these levels in the past, we got a few hiccups. Let's call it that. I mean, yeah, sometimes it just a small pullback. Sometimes it's actually a bad market. Okay, but just it helps you maybe to understand where you are in the grand scheme of things. So could be useful maybe. But this is interesting too, at least studying to the Financial Times, right? It looks like at the same time, while the market is on a tear, right? The insiders, which are corporate executives and whatnot, they are selling. So, it's the other side of the coin. Everyone is massively excited about the market, which is roaring, but people which are actually running the underlying companies of these stocks, they're actually getting rid of their stocks. Like, the most famous example is basically Warren Buffett, which is piling in on cash recently. It was selling what? I don't know. Was it Apple? I guess. Yeah. He was selling Apple. He also reduced his positions in Bank of America. So it's a huge place. And not to mention we actually this is going on since I guess the end of the summer. It was late August, mid-September, I guess. That was Jeff Bezos unloading massive amounts of Amazon stocks. So again, you see that it's not a good timing tool, but it kind of shows you that even these guys, which can touch firsthand what's going on, inside the financial markets or the corporate environment, if they are selling so much, maybe they perceive some sort of a risk. Actually, being an outsider, you perceive that. Them being the insiders, they actually see or the risk, or not only the risk, but what what is actually a problem. So it might be why they're deciding to unload or to reduce their exposure so much, right? Although, at the end of it, overall, you see a massive amount of inflows when it comes down to all these American ETFs. So the at the end of it, the sentiment is bullish overall, and the market moves on liquidity. So as long as you got flows coming in, the market, all rest being equal, it's gonna move higher, right? Up until it's like the market will keep on going higher up until the point the last buyer's bought. That's it. And there is still this kind of quote unquote controversy about the Max 7 against the rest of the market, and the breadth of the market, which is particularly narrow because it's basically seven stocks which are driving the entire index for the US market higher. Yeah. But I mean, although it's not a perfect balance, what you can say is that yeah, these Max 7 they are massively outperforming, but at least it's not like the index is moving up because the Max 7 are basically doing well and the rest of the market is in negative territory. No, well, it's just that the rest of the market it's still going up, but not at the same rate of change. But yet it's going up. So up until the point you have this situation, it's good. I mean, it starts to be a bit less good. And you see these Mark 7 keep on scoring record numbers, but the rest of the market might get negative. At that point, you might say, well, now the risk is really ramping up because it just takes a little bit of a problem for one of these seven stocks at this point to bring down the overall index, right? So that is kind of the dynamic at play. Okay. As for the risk, of course. Now, it's not just U.S. entities or U.S. consumers and investors and retail pouring money into markets. it basically the flows are coming in from all the entire world. And although emerging markets reduced a little bit their exposure or their equity or their flows, right? I mean, it's like Europe went a bit down, but it might be because in Europe there's no more flows. We are not really holding up very well. At the end of it, though, if you look, let's say, at Japan, it's positive. Internationally, it's still positive, right? So, and when you say international, as you can read, it's basically funds which have a little bit of a global mandate. Okay. So again, money are coming into the US markets not only from the domestic US liquidity pool, but all across the globe, it looks like, which is why US markets are massively, overperforming the rest of the markets out there. And this is another sign of exuberance, right? When you see volumes getting into, a 3x ETF, uh, it shows you massive confidence, but also massive exuberance again. And this is some sort of an average of all the leveraged ATF. So, or maybe this is about growth stocks, could be. It's still uh, somehow you know, how can I say that? It still reflects the same phenomenon. I'm just kind of hesitant on the name of the potential ETF or group of ETFs. Still, this is a testimony of flows coming in yet. So at the end of it, that's what you really focus on. Now, yeah, I guess I could have digged a little bit more into the name, admittedly, but we're not perfect. I'm not by any means, right? So how does it end up? Well, it ends up usually when you see estimate growth, estimate earning growth, kind of mean reverting a little bit. Uh, so the gray shaded area is usually, as usual, they are recessions. And you see when earnings growth estimate picks up, usually the market does the same. Because at the end of it, we discussed what is something like price to earnings, right? Well, it's basically just a measure, an assessment of the current psychology of the market. If you are willing to pay a hell of a lot of a premium for a stock with the promise that earnings will keep on growing into the future, well, when someone comes in and tells you, you know what, we revised down our earnings growth projection for the next 3 quarters, then you're going to say, wait, so what? But I just bought in because I thought earnings would have grown to infinity. And now you tell me they're going to be, stagnant or if not coming back down. Why would I want to hold this stock now? And you got the reverse process occurring. That's it at the end of it. So, that was it for equities. Now, everyone is kind of trying again, getting back a little, circling back a little bit to the beginning. Everyone is kind of trying to call the top and to know when the top will come in and to time it. I think there is really no way to do it. I mean, on a large scale, like there might be the usual 20, 30 people in the world which will be able to do it, but for the vast majority of people, it's going to be impossible. But there's one thing you can look at least to assess the risk of something big coming in markets to the downside, I mean, and that would be something like the credit spreads. Now, what is a credit spread? It would be much easier if you just Google it, but essentially, as the name suggests, it is a spread, so there is a difference. And when you look at credit spread, there are many. So first and foremost, there are many type of spreads, right? But the core concept is that you compare the yield on something like US Treasuries, which are, of course, considered the free risk rate, right? Because, the government can't go bust. So you know that if you lend money to the government, you're going to have them back, principal plus interest. Now, it is a free risk rate in nominal terms, of course. If you come and say, yeah, but in the meantime, there will be so much money debasement that the money that you get back are not worth as much as what you lent out before to the government because of inflation and purchasing power going fuck. Absolutely. I'm just discussing nominal terms. And that's what matters in this spread, right? So it is a difference. And if you look at it now, it looks like this ratio, it's particularly low now, actually historically low, which means that in a nutshell, you're not, pay attention, you're not compensated to hold bonds which are not government bonds. Let's put it this way. If you buy a 10-year treasury, right, in 10 years, you're going to have the principal back plus interest, right? Okay. If you buy a corporate bond, let's say, now let's take Apple or Google or Tesla, or, you know, they of course issue bonds because they need to finance themselves, and they got access to the credit market, so they can issue a bond, collect the liquidity they need, and promise the investors to pay back the principal plus interest. Now, usually the rate, the yield that the market would ask to these corporates or private entities, it's going to be a bit higher compared to the yield which is set for the bonds, the government bonds. Why? Well, because you know that the government can't go bust, but a private company could. So you have to factor in that little bit, quote unquote, little bit of a default risk. So the actual risk of not getting your money back. So you want to be compensated a bit more if you lend money to someone which could actually go bust instead of lending them out to the US government, which cannot in nominal terms. So if the spread it's really, really tight, it basically says that there is not a lot of risk perceived in the market because basically the compensation which is asked on a corporate bond and a treasury bond, it's kind of the same, or the difference is really narrow. When you got the opposite effect, the spreads actually widen up. It means that basically you're asking a hell of a lot more compensation to buy and own and hold a corporate bond because now you think, well, the economy maybe it's not so good. Oh, look at the companies. Their earnings are going down. Oh, look, they're cutting heads. They're firing people. They're laying off people. Oh, look at the sales. The sales went down, so these companies probably not going to be able to generate the same amount of revenues. Um, will I lend my money to them? Yeah, maybe. At least, at the end of it, it's still Apple, it's still Google, it's still, I don't know, whatever. It's still Microsoft, right? But I'm not expecting it to go out of business in 1 year. But uh, if I lend them out to the US government, I'm sure I'm going to have them back. If earlier I would have asked for, let's say, 3% as a yield out of Google, now maybe, yeah, unless they offer me a 4.5, 5% yield, I'm not going to lend them money to them, and I'm going to stick to the government bonds. So that's the core principle of it. This is it. I mean, you could expand on it, but at the core basis, this is it. This is just the logic behind it in a nutshell. Okay, so naturally, if you look at the spreads, and in this case you're looking at the treasury bond, and again pretty much a huge variety of corporate bonds, because you've got your B's, your A and whatnot. If they are narrow, as you can see, when they are particularly narrow and low, right, and tight, so to speak, you look at the annual percentage change of the S&P, which is particularly positive, right? while when they widen up, you got negative returns for the S&P. So it gives you a lot of indications, right? Now, let's check these, for instance. Now, this is instead the credit spread for US Treasuries versus the junk bond, right? Now, junk bonds, it's basically what is now called high yield bonds because it doesn't sound fancy if someone comes at you saying, would you like to buy some junk bonds? What? Junk? Why would I want to buy junk? It's way better if I come at you saying, would you like to buy some high yielding bonds? Yeah, I mean, high yield. Yeah, oh, well, they're going to yield me more. I'm going to make more money. Yeah, let's go. Let's go. Right? Let's buy them up. Oh, we're going to make a lot of money. Look at the returns, right? Yeah. But if you follow the previous logic, they are yielding you more because the risk implied it's a hell of a lot higher. So that's why they're junk at the end of it. And same type of a logic when they blow up, you see massive repercussions on markets. So they got a good track record. So, again, because think about the terminology, think about the name, right? Credit, credit spread. Okay, so what is credit? Well, I've been talking about it many, many times in the past, especially when I was talking about the dollar. But in a debt-based system, in a debt-based economy, credit equal money. And on the other side of it, there is debt. The majority of money into existence, it is actually credit. They're lent out. So when you look at these, you could also say they are a measure of actual liquidity into the system. Or at least they are a measure of the perceived risk of liquidity availability into the system, right? Now, even if you see spreads kind of blowing up a little bit or starting to tick up a bit, just bear in mind that historically there is still this to take into consideration. Again, getting back to calling tops or doom and gloom or whatever. This is a little bit of a reminder of how long bull markets could go. Now, again, you can see the numbers are particularly spread out. There is a lot of variance into it. So you might want to average it down or to make all the nice type of adjustments you'd like on it. But just to show you that sometimes just because a market is particularly oversold or it's going up for a particularly long period of time, it doesn't mean that it's going to come back down just because of that. You know, it could keep on going higher for a long, long time yet before actually coming down. So just as a reminder. Oh, just forgot. I actually had a little bit of implications for credit spreads. Let's see if I remember correctly. Yeah, risk sentiment shift, liquidity trade. Yeah, right. No, wasn't completely out of track. Corporate financial health. Yeah, of course. Corporate solvency. Yeah, all right. I mean, just I'm not gonna repeat that, but you can read it. It might be even better than what I just said, but yeah, right. Now, oh, this is if you remember, the first was A, B, mostly toward the A. This one is the BB tranches of you know bonds, corporate bonds. And again, it's kind of the same story here. I mean, you could actually go on the Fred database. They got the same at the end of it, right? Now, this should be kind of a little bit of a broad index of high yielding bonds against, of course, the US Treasuries. Then what you got is the double B rated and the triple B rated. You should have all of them on the thread database. Actually, let me check because we should have that. Let's see. Yeah, basically I just left the Chrome tab open since where I took the screenshot. So yeah, basically you have them. And if you want a little bit more of a detailed explanation, you can go into the notes and look at what they actually express and how they are built up if you want, right? I'm not going to do that because it could could take too much time for me right here, right now. But you know you got it, right? So we discussed pretty much everything. What we still need to go through is, as usual, bonds and currencies. Now, let's have a look at yields. Now, if you remember, now, of course, as I say, it's always difficult to time markets, but if you remember, at the beginning of the month, I was like, this might be the beginning of top information. And of course, it wasn't, right? The market just kept on going higher, a bit more, not really making new highs, at least, on the long end and the 10 years here. Kinda, a little bit on the 2 years, maybe, right? If you look at the yields, there is a little bit of a higher high, while instead in here you got tiny in here. On a closing base, yeah. On a spot, on a shadow, a weak base, no. So, yeah. But anyway, it was looking like a top information. It took a bit, a bit more time than anticipated, right? But eventually, it looks like we are maybe seeing a top forming. I say maybe because at the end of it, you could still have a few ebbs and flows into it, and you know, it's not guaranteed that these yields are going to crash back down. Uh, it was a choppy market in here, and nothing tells you that it couldn't be a choppy market on the way down. So just, you know, don't expect an easy ride if you are uh, kind of bearish yields and therefore bullish bonds. All right. But I mean, they seem like they put in a top at the current moment in time, or they're really trying to put in a top. Could you have another type of a bounce before actually going down? Yeah, absolutely, considering how they moved, right? But overall, I think, I'm still maintaining that view of lower inflation into the future, lower growth, and therefore lower yields on bonds. Um, the the ETFs on the actual treasuries, they had this little bit of a rebound. Now, if you remember, for the disposition we got, at least on my end, was to wait for this level to be reclaimed. We broke out these, I don't even remember how you call it. I don't know if it was a broadening wedge. Let's just call it a downward channel, right? We broke out of the channel. It looks like we might have been able to reclaim this level, which was support, resistance, resistance, resistance. Now, resistance flipped, maybe. Again, could you have a retest of this area overall before the actual leg up? Maybe, yeah. But I guess if from here till year end you don't see these assets making new lows, we could still confirm the thesis of yield coming back down together with inflation and everything else. All right. So that's where I would stand. It's not just because of the bond itself, or at least the treasuries, when you look at the US. It is also because, and I know many people tend to forget stuff really, really quick, but I recorded a video at the end of October, beginning of November, maybe, probably more to the end of October, but I was looking at these back then, and I was saying, yeah, This level of ratios in between the puts and the call, uh, historically it coincides particularly well with treasury markets bottoms. So it might be a bumpy road, but I think overall the market will try to put in a decent bottom at a point. So eventually it did. I mean, it took a hell of a lot of time, of course, uh, but if you look at the grand scheme of things, all in all, this down move was getting a bit exhausted after the initial spike down in here. So again, as I said, just need to have patience when you look at these macro trends because we're talking weeks, if not months, sometimes. So, well, if not years, sometimes. So it's very easy to call for something, and then 2 weeks later saying, "Oh well, I thought, but no, 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 I changed my mind." Look, I don't have anything against it. Like, just say if you are a trader, that is actually a very good skill to have, right? But just make up your mind on what you want to be and how you do want to set up your positions because being a trader is one thing. uh, when I say trader, I mean like intraday trader, short-term speculator, right? If you want to be, let's say, a little bit of a mid to long-term investor and you look a lot at the fundamentals, well, then you need to be willing to wait for those fundamentals to catch up. Or, well, actually, it's the other way around, for price action to catch up with the fundamentals, right? So it's not useful if you keep on changing your mind every single week or every single month just because you see price ebbing and floating around. Uh, so be specific on what you want to be and what you're going to do because otherwise it's going to be a mess, right? Now, connected to it, we might also observe that overall there is a little bit of a similarity in between what yields actually did this time around compared to what they did in 2001. Now I know, 2001 was the dot-com bubble, but you just said, "Oh, don't try to call tops and to call recessions." Absolutely, I'm not. I'm just saying that I'm not looking at it from the standpoint of, oh, okay, this is the top in markets as for equities. I'm saying it's a little bit of a similar situation because even back then, if you remember, we got into a rate cut cycle. So I'm looking at the monetary dynamics, not strictly at the price action of other asset classes like stocks or gold or whatever you. I know they are impacted, but I don't know when and how and why or what could be the trigger. I'm just looking at the bond market and the yields in isolation in this case, just to be clear, right? And you see that there was this divergence back then, and it looks like we are seeing the same right here, right now. Now, there was a little bit of that September effect, starting late August, getting back to the first 2 weeks of October. You see that historically treasury yields they tend to go higher, and it's not only true for the US, it's a global phenomenon. You can check the German yields, you can check Japan, you can even check China if you wish. They tend to exhibit this behavior. It's not every single year, of course. I recorded a video on these also, of course, but starting from, I guess it was 2009, I think. So over the last 15, 16 years, there have been only 3 years where it didn't manifest itself. But maybe it was three, maybe it was four. But overall, the majority of times you've seen this behavior, right? In this period of the year. So again, it's a seasonality type of a study, right? And it looks like we might see the same thing happening again. Maybe, hopefully, who knows? So this is just another parallel in between what happened in 2001 and what is going on right now. We are trying to build up a case for yields to top out. We don't have a really huge confirmation yet, but I'm gonna stick my neck out and say this is a good start at the very least. We'll see how it goes ahead, but as for now, it is a good start. It doesn't mean that you wouldn't need to manage your risk if you have exposure, but I mean, it's always better to see them reaping higher at the very least, right? And speaking of Germany, you can see that even in Germany, we got yields from August, September coming back up and then going back down. So it's not just in the US at the end of it. Um, you could look at it and saying, oh, okay, if you compare basically the German curves to the US, could it be that Germany is actually leading here and then the US will follow in line with what Germany is doing because overall this is a globally synchronized type of thing and markets are all connected. It's a global system yet. So could this be? It could, maybe. Uh, I wonder, do we have any historical precedents? Oh, well, it looks like we got it. I mean, it's very short term, of course, but there is a nice relationship in between, the boons and the 10-year in the US. Now, let's see. You might say sometimes it's the boon which is leading, sometimes is the US leading. Let's just look at the tops, right? When it comes down to the tops, who's topping out first? Although the scale might deceive you a little bit, I think in this case they basically broke, if you look at the structure, they broke structure together. But as we did on the indices a bit earlier, we could say, yeah, but in this case, you got a high in the 10 years in the US, higher high in the 10 years, lower high on the boon, and then both comes back down. Nice SMT divergence. Thank you, Michael. Then in here yet, what we got? A little bit, right? A high here and a high. A high high in Germany and a lower high in the US. I mean, beyond the correlation alone, you could also look at the divergences in between them. It might be interesting. What we got here, we got a high, or one, two, three highs in the US. If you look at the last two, high, 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 lower high, and now they're topping out. Could this be? I mean, it worked in the past. Sure, you could check all of them and see how many times these statistics actually hold truth. But it's interesting nonetheless, I guess. Then, oh, China, it's another one. Looks like there is still this massive bond rally in China. Although, again, you remember all the stimulus in China and the index in China, the stock index actually rebounded a lot. And now, this is the recovery. China is going to drag the entire world out of the potential recession to come. Is it? Because if you look at the yields, they're back down to levels of 2020, which should mean that the bonds more or less should be around the highs of 2020. Wasn't a good period for Chinese stocks, or yeah, well, for the entire world, for what matters, right? I mean that if we talk risk on assets, that should be kind of a warning sign at the very least, right? It's not. See why I say it's a signal of a potential risk. It doesn't tell you that you're gonna have a top in major equity markets on Monday morning, right? But yeah, it is something you should pay attention to, right? What else? A little bit of a zoom into Chinese government bond yields. Yeah, just to highlight that they tried to go with that stimulus proclaims and claims and yada yada. And it looks like, yeah, I mean, they got a little bit of a rebound, but overall, If you look at the 5 years and the 10 years, we're back down at the lows. 2 years is lagging a little bit, yeah, but same concept applies, right? Now, let's check currencies to end up. DXY, it pulled back a little bit, which is normal, I guess. We hit, uh, still in the context of this range, we hit a decent level of deviation out of the mean. So we are now hovering around range high. Let's see what's going to happen in the coming week. The euro, of course, rebounded a little bit, had this massive bounce. Same for the pound. Didn't really got down where I thought it would have been. Like I was looking at this level, but was front run a little bit. What was interesting was the yen. Remembering all the talks about pay attention to what whoever is gonna say because we don't know. Last time, actually, well, not him because it wasn't appointed yet, but last time we got a little bit of a spike to the upside in the yen. Uh, you know, even US indices were impacted a little bit, if you remember. That was the infamous carry trade unwinding in here, which is why I was looking at the yen. We broke out of the trend line. We bounced off this nice base in here. We got all this liquidity, which seems a bit splashed, a bit sparse. Now we got this gap in here, or could be this apex right in here. Could be. I mean, if the yen keeps on rallying higher, you should expect what? The dollar coming back lower? Could the yen also put the euro in his back pocket and helping a little bit the euro rebounding? Maybe. Yeah, it remains to be seen, I guess. Um, and most importantly, the big question would be, can it be sustained? I guess, I'm just, putting out random questions. I'm not trying to get to the answer yet, but just saying this is something I'm monitoring and then I'll keep on looking at for, I guess, from here to year end, basically, if and even beyond that. The carry trade it's a particularly a good source of risk. So if I have to manage risk, yeah, absolutely, I'm gonna look for it uh, at at it, right? Added back a bit of the BRICS currencies just to, I mean, hmm, are they holding up particularly well? Let's go on the monthly chart. Wouldn't say so. Brazilian real, new lows, below 2020 lows. Russian rubles, there was this massive spike into 2022 when the war in Ukraine broke out. But if you, I mean, I, it's not something you should do. Just a little bit of a disclaimer. It's not something you should do. But if you try to smooth out the spike in volatility for, the beginning of the war, let's just do these. If you look just at the monthly closes, it's making new lows, right? So even the ruble is not holding up particularly well. Chinese yuan at lows, tried to put together some rallies, never really got a lot of continuation. Indian rupee, uh, I guess maybe the Indian rupee is the worst because not only is going down, and it's going down since like forever, it was 2017, but it's really drifting down. I really don't like the drift. The drift, in my experience and in my framework, the drift shows conviction, in this case on the part of the sellers. So, yeah. Speaking about foreign currencies and central banks relative to the US, it was nice to see that South Korea unexpectedly reduced the the rates basically two times in a row. And that thing wasn't happening since '09. Historically, South Korea central bank was always being particularly careful in, you know, sending out messages like, but essentially, if you cut two times in a row, it's like, we are getting into panic mode. While instead, if you cut, then you pause. If you cut, then you pause. It looks like, yeah, yeah, we got it under control. We are managing it, but you see, we're not in a hurry. We are not running for the hills because we don't need to, right? There is no emergency here. There's nothing to see here. Go ahead, right? But it looks like they did it two times in a row this time around. Again, could this be a massive problem? It is just one data point, right? So take it for what it is. But if you start to put it up, everything together in the context of these emerging markets, BRICS markets, currencies, and what have you, global dollar flows toward the US markets, as we've seen, rates in the US, which overall are still particularly high. So considering that a lot of debt outside in the rest of the world, it's actually denominated in the US terms or US denomination. Uh, it puts a lot of pressure on funding and refinancing capabilities for all the rest of the world. So, I think the Central Bank of India is actually, let's see, I should have it. I was reading it before. Yeah. Uh, yeah. I mean, you could just go and watch it or read it, but essentially, what's going on in India with the central bank, and this is coming from, I would assume this is an Indian name, so it should be an Indian report, if you want to trust that more, since it, domestic report maybe. And it's pretty recent, November 29th. If you read, it looks like they put up a massive short position on the US dollar in order to try to backstop the currency from going down against the US dollar, right? So they are intervening in these what they call NDF instruments or markets. It's basically the offshore market because it should stand for not deliver something. There's not. There should be the explanation somewhere in here for NDF. Anyway, the bottom line is they are putting up this massive short position against the US dollar to basically, yeah, offshore, to basically backstop the currency from being crashed by the dollar spiking to the upside. And I guess, I don't really think they're doing it because they think they can win the war against the, I don't know, it could be the Fed when it comes down to monetary policy differential. But I think they're doing it to spook speculators out. It's what the Bank of Japan did like months ago, or what the Bank of China did recently. You come up saying you're strong and powerful and mighty, and don't you dare, speculators, shorting our stock market, shorting our currency. Don't try to attack us, quote unquote, financially, right? Because we are mighty and powerful and we are gonna blow you out of the water. Your short are gonna be short-lived and you're gonna be facing a margin call relatively quickly if you try to, you know, challenge us. Has it ever end up well with for everyone or anyone? No. At the end, the foreign entities they always had to throw in the towel because really it's not speculators. At the end of it, I guess it's all about for sure. It's all about forward guidance. It's all about sending a message. But they know, I guess they know very well, they're not really fighting against speculators. They're fighting against the entire market. And if the market is going one direction, it's because the market sees or perceives stuff which makes him think, you know what, I'm not going to take that risk anymore. Or, I need to get out of it because the risk is growing too high for me. Fuck it, I'm out. Uh, so how it's really hard to fight market's force of gravity. Gravity always wins eventually. So, I guess, yeah, with that, that's it. I mean, for a light trading volume week and a festivity type of a week in the US, I might say it wasn't that poor of events, right? Of course, I focused a bit more on other stuff instead of equities alone because, yeah, I actually almost didn't even trade it. Traded Monday, Tuesday, but I was almost done on Wednesday. And then, of course, Thursday and Friday, I was completely sitting on my hands doing other stuff. Not necessarily productive stuff, but yeah, I'm actually thinking of taking a huge break starting from mid-December up till after the first week of January, a little bit of a vacation holiday. I like that. I like to disconnect from time to time, so why not? Yeah. Other than that, I'll keep on monitoring markets, of course, and yeah, I'll keep on bringing on these weekly market recaps. I just think I'll be less engaged with my day trading activity for many different reasons, right? One is health. I like to take breaks to keep my mental sanity. One is holidays, one is family, one is why the fuck not? I mean, right? So, again, it's gonna be an interesting last month of the year, and I keep on thinking we're gonna see volatility overall. Yeah, it's gonna be interesting. So, getting into next week, of course, wish you all the well possible for your trades. Be nice and be cool as usual, and we are gonna look back at it next week for another recap. Nils out.